So my name is Terry Quinn, and I work in Irish economic analysis. And my main day job essentially is managing the group that produces the forecasts for the economy that we publish 4 times a year in a quarterly bulletin. We also do some forecasts with our colleagues in the ECB and other national central banks in the Eurosystem a couple of times a year. And essentially the main reason we do this is to inform monetary policy. So the single mandate of the central banking side of this institution and the ECB is price stability. And so monetary policy is designed to maintain price stability, and an important aspect of that is to have a sense of how the economy is doing, what the level of activity is, what the prospective growth rate is, what the level of activity is relative to potential. So is the economy overheating? Is it depressed? So it's important in that respect. But it's also, we have a responsibility to provide advice and to inform government policy. So again, it's important that we have a good sense of how the economy is doing. So I suppose the focus on what we're trying to measure here is sort of the total output, net output in the economy, net value added, national income, total aggregate demand or expenditure. So I mentioned those 3 things, but actually, properly measured, they actually amount to the same thing. So if you think of it at a firm level, the output generated, net output at a firm level, corresponds to the income of the people working there, to the profits that are generated for the owners of that firm, and etc. And and also the sales correspond to expenditure, whether it's consumption or investment or exports, and the inputs that are purchased from outside the country are imports. So in practice, so there are actually, if you study economics at that stage, one of the first things you learn is that there are 3 ways of getting at, say, measuring total national output or GDP. So the income method, the expenditure method, and the output method, and if they're properly done, they should give you the same number. But of course they don't, because that's a measurement error. And in practice, the easiest way to approach this is to look at it from aggregate demand or expenditure. So that tends to be what we do. So when we publish our forecasts, we talk about growth in the economy in terms of GDP, and then we look at the constituents of that, like total consumption, whether it's private consumption or government consumption of goods and services, and investment, and exports minus imports. So they're actually all expenditure aggregates. And I mean, that's really done for convenience, and it's easier to do, essentially. So just to give a sense of an overview of what I'm going to say here. So we published forecasts, most recent forecasts, at the end of July after the publication of the annual national accounts. And so for what it's worth, there are the numbers. In summary, there are GDP growth. So GDP stands for gross domestic product. So that captures the total level of net value added produced in the economy. And so last year it grew by 7.2%, and we're forecasting growth of, at the moment, although it's under review at the moment, we're forecasting growth of about 4.7% this year, and slowing marginally to 4.2% next year. And this is really growth has been driven by pretty strong export performance, which has been sustained for quite a while. And domestic demand is actually accounting for most of that growth. And what we mean by domestic demand is consumption and investment and government consumption. And on the back of that strong performance, the labour market is doing very well. So we've sustained about 3% growth every year in employment, year on year, every year for the last 6 or 7 years. And the unemployment rate has correspondingly fallen quite a bit from the bad times from 2008 to 2012. The unemployment rate went from about 5% to 16%. So it's currently just under 6%. So it's fallen over 10 percentage points. But we do have a problem here in that the standard sort of matrix for the size of an economy and its growth rate is this GDP measure, which is the total net value added produced in the economy. But in the Irish case, for a long time now, GDP is actually, it was capturing fairly accurately the total level of activity in the economy, but of course, as you know, we have a big multinational sector. And so the profits generated by the multinationals flow out of the economy to the owners of those firms abroad. So in terms of actually income that we get to keep from that output, it's smaller. So you may have noticed over the years, there's always a reference to GNP in Ireland, so rather than GDP. And for most countries, actually GNP and GDP are pretty much the same. But in the Irish case, GNP is a lot smaller. Well, about 15 to 20% smaller. And the difference between the two is basically accounted for by these what we call net factor flows, basically the profits flowing to the big multinationals that are based here. So our GNP is smaller, and that's always been important. So when we're drawing international comparisons, say looking at government debt levels, so debt to GDP ratio is a standard measure of how indebted a country is. But in the Irish case, because GDP is a bit too big in terms of our income, we have traditionally referred to GNP. And there's a closely related measure called gross national income. That's very similar to GNP. The difference is basically the net subsidies minus taxes at an EU level. So as you know, we contribute to the resources of the European Union, and we get back spending in terms of the cap, etc., and structural funds. And in the Irish case, that's slightly positive numbers. So our gross national income is supplemented by these net subsidies from Europe, which are about $1 billion a year. That's fine, but because of a combination of the behavior of the multinationals and changes in national accounting rules, from about 2011-12, things started to go a little awry in that GNP now was exaggerating the size of the economy. So we had an economy that was recovering quite well, but so GNP and GDP were essentially becoming distorted. That distortion became particularly acute in 2015. You remember the leprechaun economy. So on paper, we were growing at 26% in 2015, which of course was nonsense. Of course, we weren't growing by 26%, but that crazy number was actually masking a pretty good performance. And by 2015, the economy was already in its third year of pretty impressive growth of 5 to 6%. Okay, we were coming from a bad place, but it was a really very strong performance. So it was tragically, in a way, that kind of really silly number was actually hiding what was a pretty good picture, So the economy was growing pretty fast. Unemployment was falling on the back of pretty strong employment growth, and we were sort of getting back on the horse. Things were improving. So why did that happen in 2015? Well, I suppose the short answer is, there was a change in the rules of how GDP was calculated in that essentially it related to ownership and sort of domicile of the various firms. So in 2015, one of the big multinationals, I won't really say who they are, transferred about 300 billion in capital assets from somewhere in the rest of the world to Ireland. And what it meant was, so what were those capital assets? Well, if you look at this is it's an iPhone. So it's I was going to say it's made of plastic, but actually it's a lot of glass. If you let it fall, you find that out, it shatters. But so the value of that iPhone is not in the glass really. It's behind the scenes. It's the intellectual capital behind that. So traditionally, when you're trying to measure capital and where it was in firms, it was pretty easy. If you're a steel mill, it was where the plant was and it was where the steel was. But the ideas behind new products are very difficult to say. Where are they located? Where's that capital? So in a sense, it's often in the gift of the firm they decide. And so essentially they decided it was in Ireland. So there was a huge increase in capital. And what it meant was also that change combined with the fact that there was a change in rules and how you measure, say, exports. So traditionally exports, if an Irish firm in Cavan sells some product to somebody in Paris, that's from Ireland to France, so that's an export. Now the rules say that if an Irish-owned firm sells something to somebody in another country, change of ownership, that's an export. So hold that thought and remember that a big chunk of the ownership of that capital came into Ireland. So suddenly all the exports associated, stuff that's made in China, all those exports are now our exports. So there was this huge big increase, level shift in the capital stock here and in our exports, and that's what generated the big growth. So we have a problem. So essentially GDP is about a third or more bigger than the actual size of the economy, and its growth rate can be very distorted. So we've had to look at other ways of measuring the economy, and so the CSO set up a committee actually that the governor chaired to come up with alternative measures. One of these was called looking at GNI, gross national income, that I mentioned earlier, and adjusting that to basically extract this component of stuff, basically activity that's happening in other countries that's counted here. So that's where we came up with this GNI star measure. But we also have to look at other underlying indicators that actually give you a better indication of how the economy is doing. And the most reliable one is the labor market. So how do we know the economy is doing well? Well, employment has actually recovered all the losses in employment during the crisis. Early, I think the first quarter this year, so it surpassed that. Now, so that reflected really strong growth in employment for 6 or 7 years, and that was necessary to get there because the fall in employment was so dramatic. But we are back there to where we were before the crisis. And consumer spending and underlying investment have also recovered. But investment is another example where there's some distortions because of the aircraft leasing firms that are based here. Anyway, the underlying position has improved dramatically, and one of the best indicators of that is the labor market. So, but interestingly, despite the fact that the economy is doing very well, the inflation rate has remained pretty low. Part of that was explained by the depth of the crisis here, and so demand was very weak. But I think in more recent years, one of the reasons inflation has been so low here is because of the sharp decline in sterling, and we import most of our consumer goods from the UK, and so they're cheaper in euro terms. But even allowing for that, apart from, say, in the housing market with rents, inflation has been very low here. And that's one of the sort of conundrums and puzzles, given where we think the state of the economy is, we think inflation maybe should be higher. So this is just sort of graphically. If you look at this, you can see, so in the color coding here, GDP is in blue, GNP is sort of kind of a mustardy color, orangey, and gray for nominal GNI. And you can see, if you look on the right-hand side, you see the levels. So back in 2007, GDP was a bit bigger, but it became really very apparent in 2015 when GDP jumped dramatically. But you can also see that all these indicators of the size of the economy, they're all going in the right direction. They all declined. In fact, the underlying measures declined even more than GDP during the crisis. But the recovery is exaggerated by GDP, but all the others are growing as well. So GNP is recovering. GNI star is also recovering. So the GDP distortion is actually distorting what's actually, as I say, a good underlying story. And just for what it's worth, these are our numbers. So GDP in red, we still have to report these numbers in GDP terms because they are the internationally accepted standards of the size of an economy and its growth rate. And then you can see the components and expenditure terms below there. Consumption, government consumption, investment, exports, and then imports are subtracted to get to GDP. But we look at underlying measures, such as this measure we call underlying domestic demand, where we take the consumption and the government and investment, but we extract from investment these IP, intellectual property asset investments, and the aircraft leasing, which is also distorting it. So to get an underlying picture. And when we look at with this underlying measure, so you can see also the strong growth in employment in recent years and the fall in unemployment and the low inflation. But so when we look at this underlying measure, we see it's a much better fit in terms of tracking what's happening in the labour market. If I put a chart up there on the left-hand side with GDP or GNP growth rate and growth in employment, there'd be no relationship. It's just, it just doesn't work. And you can see on the right-hand side, the depth of the crisis is really, it was actually understated by looking at GDP. When you look what happened in the labour market, the decline in employment sustained over those 3 years, 2007, 2010, is really, really quite dramatic. But also the recovery, if you look closely, you'll see initially it was just part-time employment, and then as people became more confident, it translated to full-time employment. But so we've had this sustained period from about 2013 to 2018, pretty strong growth in employment. And this is again looking at it graphically. You can see, so in terms of total, we're back at past the peak level before the crisis. And even by 2015, excluding construction, and about half the job losses were in construction, we were back to where we should have been. And this is just looking at it regionally. I think it's generally known that Dublin has been doing a bit better than other areas, but actually the difference is not that dramatic when you look at it. So if you look at the darker blue line, it's looking at the level in 2018. The low point was second quarter in 2018, so that's equal to 100. If you look at Dublin, it says 126.5. So what that's telling you is that the cumulative growth in employment in Dublin since the low point is 26.5%. But the national average is 20%, so it's a bit better, but not dramatically so. Some areas haven't done so well. The Midwest and the West, not so well. So areas that maybe are more dependent on agriculture, where they don't have some of the high-tech firms, etc., haven't done as well. But the difference is not that dramatic. And similarly, the unemployment rate, if you look there in the worst of times, the Midlands was the hardest hit. And that reflected the fact that the share of construction employment in the Midlands was pretty high. So if you think of half the jobs that were in construction, it's not surprising that region was hardest hit. It's actually, if you go back and look at the growth in employment, the Midlands has actually done quite well, but because it fell so far, it still has a lot of ground to make up. So at the moment, the area with the highest unemployment is in the Midlands. But again, the difference is the divergences across regions are not that dramatic. So now, in terms of looking at the labour market, the issue is not how are we going to get the unemployment rate down, is the issue is where the work is going to come from to fill the jobs that are going to be generated. And if you look at this, this chart on the left-hand side, looking at short-term and long-term unemployment, you can see there's been the level of short-term unemployment is almost back to where it was before the crisis, and that is also the case for long-term unemployed. So, and participation in the labour force hasn't really recovered so much. Part of that is that the high level of participation during the boom was reflecting the fact that a lot of younger men in particular, who should have stayed in school, left and were working in construction. And they have tended not to go back into the labour force. They've stayed in school longer, and so that's kind of a good thing. But the increase in participation is not going to generate the jobs or the people to fill those jobs. So where they're likely to come from, increasingly, apart from the natural increase in the labour force with new young workers entering the labour force, is from inward migration. And that's turned positive in the last couple of years, and the more recent numbers shows that it's ticked up quite a bit. It's not quite where it was just before the crash. You can see 2006 to 2007, there were quite really large numbers of people inflowing into the Irish economy. We went from a country with very low numbers of non-nationals to being one of the highest as a share of the labour force in the EU. And so that's likely to continue because this is going to be still quite an attractive place to come. And as the economy is doing well, fewer people will be leaving. But there is an issue, we're growing strongly, and we may run into the buffers in terms of finding people to fill those jobs. So as I said earlier, so consumption is recovering, the economy is recovering quite strongly, and not surprisingly, consumption is being driven by the recovery in disposable incomes. Not so much as a per capita level, because if you look on the right-hand side, you'll see what we call compensation for employees. Basically, that's wage inflation has been pretty weak in nominal terms, that's in cash terms. So most of this growth in aggregate disposable income is coming from more people working. So individual workers are not earning that much more, but there's more of them working. So that's supported a recovery in consumption. But even though wage inflation in nominal terms has not been that high, it's against the background of relatively weak inflation. So when we talk about real income increases or real wage increases, that's basically looking at your nominal increase minus the inflation rate. So if you think about it, if you're getting a wage increase of 5%, but inflation is 6%, in real terms, your income is going down. But at the moment, you're looking at 2.5% to 3% wage inflation with inflation not much more than 0. So it's corresponding to a reasonable increase in real incomes. So again, so as I say, consumption has recovered, but actually the country's got, the population has also gone up. So when we talk about per capita consumption, we're talking about the total level of consumption divided by the population. So while the total level of consumption is recovering, the population has also gone up. So actually in per capita terms, we're not quite back to where we were before the crash. And similarly, when we look at investment, this IP investment in intellectual property assets and this investment in aircraft by leasing firms is flattering the total level of investment. We strip that out, you see that underlying investment is recovered, but it's still not quite there either. One of the reasons for that is that the huge collapse in housing output. While housing output is actually growing quite fast, it's growing from a very low base. You can see it's still way below. We think this year probably about 19,000 houses will be completed. I mean, just as in terms of comparison, before the crash, it was like 90,000. So we went as low as under 10,000. So we went from 90,000 to under 10. And now we got back towards 19, which is quite a big increase, but it still has a long way to go to reach the sort of levels of output we need to meet the housing need. And it's been the main drag in terms of underlying investment recovering to where it should be pre-crisis. And there's just, this chart is just looking at inflation. So you see that the positive red bars there are what inflation in services, whereas goods inflation has been quite negative in recent years. The big factor behind that in the last couple of years has been the decline in sterling, and it's brought our inflation rate down. But even the services inflation is not that high, apart from really when you look beyond the housing market and rents, there isn't much inflation anywhere in the domestic economy. So that's just illustrating that, that apart from the sterling effect, generally goods price inflation has been weaker than we expected. We think there may be some measurement issues there, but we're not entirely sure. So that was a quick run through, maybe I hope not too quickly, through the what we do and what we think the prospects are for the economy going forward. So there are lots of risks, and we always, at the end of our forecast, we talk about the risks of the forecasts. This is basically to cover our blushes when we're wrong. But it's also, it's a reality. We're a very small, in world terms, we're a very small economy. We're quite a wealthy economy. Incomes relative to other countries are quite high here, but we depend very much on international trade. And so we're very much like a cork bobbing in the sea in terms of, what the shocks internationally. So there's always stuff that's going to happen that catches us from left field that we don't see happening. So there are always a lot of risks from external factors to the Irish economy. So I suppose when we talk about conundrums, the issue is, I talked a lot here about difficulties in measuring the size of the economy and the growth rate. So that's very important in terms of an important policy advice we have to give is, how close is the economy to full capacity? What's the dangers of overheating? If you find it hard to actually measure accurately the size of the economy and its growth rate, that can be a difficult question to answer. So I suppose one of the sort of risks is, if policy is pro-cyclical, what do we mean by that is, I suppose if you think about it, that's if the economy is growing fast and you say you want to, and the government spends more money, it's adding to demand, and it could be adding fuel to the fire. So we have a housing crisis, we need to build more houses, but one of the risks here is, in building those houses, we're adding to demand in the economy, and we could cause the economy to overheat. So that's what you call pro-cyclical policy, when you're sort of adding fuel to the fire. The idea would be, as much as possible, to have sort of anti-cyclical policy. So I suppose building those houses when the economy is depressed and you don't need them, so that they're there when you do need them. But that's obviously difficult to do. And I suppose the complacency risk is forgetting how vulnerable we are to international pressures, so to the fact that we're highly integrated in a world economy which can occasionally jump up and bite us. So the domestic challenges are, what's the spare capacity in the economy, and how can we avoid pro-cyclical policy? The external risks, obviously, Brexit is the big one. So if Brexit goes badly wrong, we're not as dependent on the UK as we used to be, but we're still quite dependent on it. So if things go bad in Brexit, it's going to hit us relatively worse, harder than other European countries. Protectionism. So there's an emerging trade war between the US and China. Tit-for-tat tariffs. So as the world becomes more protectionist, and a country that's more dependent on trade is susceptible. It's a riskier prospect for such a country, and we're basically one of those countries. And similarly, international tax regimes. It's not. I think it's well established, that one of the attractions here is a low corporate tax regime that attracts these multinationals. And if the rules of the game changes, we could be vulnerable in that regard. So the outlook for the economy looks pretty good. We're at the moment we're updating our forecasts, and the chances are that the forecast will be going in a positive direction because all the indicators are very positive. So the outlook looks better, but there's still lots of risks there, and we have to be cognizant of those.